Welcome back. So we're looking at a piece that makes a bullish case for OKLO. The core argument seems to be that Wall Street is completely misreading the recent sell-off and just ignoring the bigger picture on its tech.
Yeah, that comes through loud and clear. And I have to say, what I like is how fast it gets to that point. There's this immediate, counter-narrative. It's grounded in some really solid metrics right from the jump.
You mean the cash position and the analyst target?
Exactly. The $410 million in cash, that 183 high target, it sets a really confident tone against the day-to-day noise.
Okay, I agree. The foundation is solid. So let's use that as a jumping-off point for the first big area of feedback. I think the analysis report could dig deeper into why institutions are so skeptical about that fuel fabrication news. It sort of relies on this idea that, Wall Street algorithms just sell the news.
Right, and that feels a bit too simple. The argument is that the progress with Idaho National Laboratory was good news, but the stock dropped anyway. And the report chalks that up to just like automated trading.
Which, yeah, that happens. But just saying the algorithms didn't understand kind of implies the market is dumb.
It does. A much stronger critique would be to actually acknowledge the real reason Wall Street might see it as a non-event. And that's usually about timelines, right?
Timelines and financial impact, yeah.
When you're looking at almost a $12 billion company that's years away from real revenue, a technical milestone, even a big one, doesn't always move the needle. Not unless it gets them to cash flow faster.
Okay, so that changes the game. If the market is laser-focused on near-term revenue, which for a stock this size is fair, then we have to use the report's own data to fight that short-term thinking. We need to show how this tech update is a financial event right now.
That's the pivot. So the suggestion is to take that great financial data that's already in the report and use it to get ahead of that institutional objection. Don't just say they're wrong, explain why their short-term logic falls apart when you look at the bigger picture. It makes the whole argument so much more robust.
So how do we do that? What's a concrete example?
Well, you have to directly connect that nearly $12 billion market cap to the fuel fabrication news. That huge valuation is what makes the stock so twitchy, so sensitive. So what if you added a line? Something like, while Wall Street is demanding immediate revenue to justify an $11.9 billion valuation, this fabrication progress drastically reduces regulatory risk.
Ooh, I like that.
And then you add, which is the single biggest existential threat for a company like this.
Because that takes their own anchor, the high valuation, and turns it around. It says the high price is precisely why this news is so important.
Exactly. Regulatory risk is binary. It's either 0 or 100. This news pushes the needle closer to 100. It de-risks the valuation today.
Okay, that's really strong. And we could do the same thing with the cash position, right?
Absolutely. You contrast the market's, fear and profit-taking mood with the reality of their balance sheet. Frame that $410 million cash runway as the buffer. It's the very thing that allows smart investors to just ignore the quarterly static.
Right. If they didn't have that cash, the market's obsession with revenue would be totally valid.
But since they do, the only thing that actually matters is that regulatory hurdle. And this news directly attacks that. It ties it all together.
Nicely done. It shows the core data was strong. It just needed to be weaponized a bit more.
Mm-hmm. And speaking of tying things together, that actually brings us to the second main critique. The report has this great long-term argument about a Sam Altman premium. The whole AI energy crisis thing.
Yeah, the big macro story.
Right, but it feels completely separate from the technical analysis section about the immediate entry point. There's just a structural gap there.
I see that. It calls the macro vision a decade-long play, which is right. And it calls the daily drop business as usual because of the high beta, over 2.0.
Both correct points.
But it doesn't connect them. It just jumps from the 2027 energy grid to the $75 support level. It never explains how the daily volatility is a direct result of that huge long-term vision.
Exactly. That beta 2.0 metric just sits there. It's treated like this random fact, but it should be the bridge between those two ideas.
It absolutely should. So the suggestion here is to make that high volatility the central, the connective tissue of the whole piece. You need to frame that 9% drop not as some scary bad thing, but as the cost of getting a ticket to that massive upside.
It's a feature, not a bug.
It's a feature, not a bug. You're paying for the potential. You accept the wild swings because you're aiming for that huge payoff.
Okay, so let's give a concrete example of how to actually write that. How do you merge the volatility with the technical support level?
I think you have to explicitly combine them in one sentence. So instead of two separate points, you rewrite it. Maybe something like, Because the stock naturally has these huge swings, with a beta over 2, finding solid support at $75 after a 9% drop is actually a confirmation.
A confirmation of what?
A confirmation that the high volatility investors are defending the exact entry point you need for that decade-long play.
I see. So the dip becomes proof that the right people are buying.
Yes, it reinforces the idea that this dip isn't a surprise. It's the expected price you pay for a shot at that 60% climb to the high target.
That's a much more unified narrative. It links the risk and the reward directly.
And you can use that same logic on the gap fill argument, too. The report correctly points out that the drop was on low volume, 10 million shares versus the average of 19 million.
Right, implying sellers didn't have much conviction.
Yeah, but you can take it a step further. Frame that low volume as proof that the institutional money, the patient capital, never budged.
So the selling was just noise, retail profit-taking.
Exactly. It tells the reader that the heavy hitters are still holding, which is a way more powerful conclusion from the same piece of data.
I love that. Okay, so that brings us to the third and final critique. We've got a strong argument, we've connected the pieces, but the landing needs to be perfect.
Agreed. The conclusion is where you make your lasting impression. And right now, the final verdict is powerful, but it could be so much more effective if it really quantified the opportunity.
It's a little soft, isn't it, after all that sharp data analysis? The call to action is, this dip is a gift for the patient investor, which is nice, it's motivational, but it lacks the analytical bite of the rest of the report.
And then it ends with that generic question, are you shaking out or are you doubling down at $75? It kind of undercuts all the deep technical work that came before it.
Yeah, so the suggestion is pretty clear. You have to use the numbers. The report itself calculates that massive discount.
The 60% discount to the $183 target.
Exactly. The final verdict has to make that opportunity financially tangible. The reader needs to walk away knowing the exact dollar value the market is getting wrong.
So instead of that more poetic line about looking at the 2027 energy grid.
Yeah, that's too abstract for a closing punch. You need to focus on the money.
You need to tell them exactly what the market is mispricing, in dollars and cents.
So what if the final statement was something like this? The material makes a strong case that the $75.94 closing price represents a calculated opportunity.
Okay.
As the market is offering this breakthrough nuclear technology at a confirmed 60% discount to its most ambitious expert valuation of $183.
Wow, yeah, that lands. That summarizes the entire thesis in one data-driven, actionable sentence. It forces you to compare today's price with tomorrow's potential.
And then for the final sentence, you replace that generic viewer question. You tie it directly to that technical level we've been talking about.
Right, so maybe you end with, the divergence is maximized at the $75 support level. And then, the question is not if you are doubling down, but whether you recognize that this level represents the cheapest entry point for a decade-long thesis.
Perfect. That shifts it from an emotional decision to a logical one.